Good, I guess, afternoon to some and morning to others. Hope everybody's doing well today. So I'm going to be kind of going through gold and silver setups, and we'll kind of go through the contracts a little bit. I want to make sure everybody's kind of on the same playing field and things. So of course, there is risk in trading. Past performance is not indicative of future results. And I'm not the best typist in the world. I got an engineering background, so I never did the English thing very good. So if you see a typo, just let me know. A little about myself. My father went through the school of hard knocks, and he didn't want his two boys to have to do the same thing. So he kind of took it upon himself to teach us about the markets. And we had to read magazines and read books and newspapers and all kinds of stuff. He had a broker whose name was Tom Busby. He was Vice President Smith Barney in Oklahoma City, where I'm from. And he asked him to kind of help him out a little bit, and Tom agreed. And so we spent time in his office learning how to analyze stocks and trade futures and all kinds of stuff. From there, he sent us off to an investor boot camp put on by a gentleman named Howard Ruff in Provo, Utah. And we got to meet a lot of the gurus of the markets at the time and learn about penny stocks and futures and charts and Bollinger Bands and all kinds of stuff. When we got back from there, my father sat my brother and I both down, wrote us out each a check for $10,000, put it into a stock account, told us we could make money with it or not, but he never gave us another dime. And he stuck to his word. From there, I got a couple of degrees in engineering, was a pipeline engineer for about 10 years. But through that time, I started out actually trading in currency bonds back in the late 80s, and then got into trading the S&P and NASDAQ futures at night. I'd actually get up at 3 o'clock in the morning, trade up until about 6:30, 7 o'clock, and then head off to work. Then of course, I'd spend the evening with the whole family, go to bed and get up early in the morning, and did that 3 or 4 times a week. Then, of course, as the internet started coming along, I got to trading into equity and equity options, still trading the futures at night, and then got to thinking, I kind of like the futures more than I do the equities. So I started dabbling into the meat markets a little bit and the grains. Then Tom started a school in Mobile, Alabama called the Diversified Trading Institute, and asked me to come down and kind of help him out a little bit. So in the year 2000, I packed up my family out of the panhandle of Texas and moved to Mobile, Alabama, and I've been teaching and trading ever since. I've traded in just about every market out there, not every vehicle by any means, but I have found that I'm more of a commodity trader than anything else. I still trade in the equity and equity options some, but I like trading grains and meats and softs and metals and things of that sort. So, and that's kind of what we'll go through today. I'm not going to go through a whole bunch of markets. I'm just going to focus just on gold and silver throughout this presentation, just so we can get a good handle on that. And of course, we can start kind of ballooning out from there if we ever want to. So let's talk about the contracts. Talk about some of the ETFs that you can trade along with, kind of what drives gold and silver around a little bit, charting gold and silver, how I chart it, I'll say it that way. And then we'll talk about some key numbers and then actually some trade setups that we can look at on that. So gold is traded, well, at the COMEX officially, but it's on Globex at the Chicago Mercantile Exchange, which Globex is their global exchange. It's an electronic trading platform that you can go clicky on your computer as opposed to having to call the pit and all that stuff. Its symbol is GC officially. You can also look at some platforms put a G in front of it for Globex, so you'll just have to kind of look at that a little bit. It trades, the contracts are every other month starting in February. So you have February, April, June, August. And there's actually an October contract, but nobody trades it. They just, once they get to August, they'll just flip to December and go from there. It's worth $100 per point. It trades in 10-cent increments, so it's $10 a tick. And it can move around quite a bit. Of course, you're controlling 100 ounces of gold, and it is a commodity, so you can be assigned that. So you have to be aware of first notice date. And you can find that at the CMEgroup.com, at CME's website. But always beware of first notice date if you're long. If you're short, you don't have to worry about first notice date all that much, just expiration. But do beware that, you can be assigned gold or any other commodities. I'll just kind of do a little detour here just real quick. You've probably heard of futures and commodities. A commodity is a futures contract, but a futures contract isn't necessarily a commodity. A commodity has a deliverable asset. So if you look at like crude oil, crude, you can get delivered 1,000 barrels of crude. But if you trade the gasoline contract, it's a financial settlement. So gasoline is a futures contract where crude is actually a commodity. And you'll find that in a lot of those different markets that they just have a financial settlement as opposed to being delivered the actual contract. So beware of that. There's also a micro contract on gold. It's same months, it's traded the exact same way, but it's 1/10 of the big contract. So every dollar moved, it's only $10. It is a commodity. You're controlling 10 ounces of gold. But if you don't like the risk of the bigger contract, you can trade the micro contract and see how it works that way. You reduce your risk by doing that. If you're having to risk 20, 30 points on gold, which is $2,000 to $3,000 on the big contract, you can cut that down to $200 or $300 with the micro, right? So, but again, beware of first notice date because you can be assigned to that. But it has the same months and trades the exact same way. Silver, on the other hand, they always call silver the poor man's gold, and I don't know why they do that, because the contract is a whole lot more riskier than the gold contract. So you're controlling 5,000 ounces of silver. So for every dollar it moves, it's $5,000. It trades in half-cent increments. So, and it's $25 a tick. And it can move around quite a bit. You'll find that silver usually, I'd say probably 95% of the time, outperforms gold going up or down. You saw silver, what was that, back in 2012, 11, 12, 13 in there somewhere, almost get to $50. Well, since then it's been down to about $12. So it got beat up pretty bad, where gold, even though it went up to around 1900, only pulled back to about 1100. It never has been back below 1,000 since it's been above 1,000. And so it pulled back, but not as much as silver did. And of course, with the recent run up that we've seen, where gold made a new all-time high, percentage wise, silver went from around $12 or $13 almost to $30. So it went up over 100%. So you'll see silver outperform gold in its moves. Now, price wise, silver didn't make a new all-time high. In fact, it only got about, 2/3 of the way there. So just beware of that. But there is a micro contract on it also. It's SIL. Now you'll have to be careful. There's also an ETF that is SIL also. So this is the futures contract, where the other is an ETF or an equity. So it trades every other month, but it's 1 month off of gold. All right. So you're going to have a January, March, June, September. And again, they skip and they go to December. So both of them have a December contract, but after that, it's just one off of the other one. It is worth $1,000. In other words, it's not 1/10, it's only 1/5, I guess it is. But it's $1,000 per point. It's $5 per tick. But again, you can reduce your risk a lot. It controls 1,000 ounces of silver. And again, it's a commodity, so beware of that. Watch out for first notice date. And the easiest way of looking at first notice date real quickly, on gold, silver, even bonds are the same way. The grains are the same way. What else is there? That's probably about it. Their first notice date is the last business day of the month prior to expiration. So when you're looking at like silver here, we're looking at the January contract, right? Well, the last business day of December is going to be the first notice date. So beware of how that, you'll see the volume shift out of the contracts, and I'll usually go to like barchart.com and just grab the commodity and look at the volume. And when you see the volume greater in the next contract, basically the traders have rolled over, and they'll usually do that a week to 3 days to a week before expiration or first notice date. And I always kind of use bar chart just to kind of give me a good sense of, hey, you know, they're rolling over to this contract or rolling over to that contract. Now you do that with all the commodities. When you look at like crude and gasoline, even though it might be the 15th of the month, when they get past the EIA petroleum status report on Wednesdays, a lot of times on Thursday, they'll just jump to the next contract, even though it's 3 or 4 days before their, quote unquote, first notice date or expiration, just because they're past the news and they're good to go. So beware of that. When we start looking at ETFs, and there's a bunch of different stocks that you can trade when it comes to gold and silver, copper, all that. GLD is probably the most popular when it comes to gold. It gets a little pricey sometimes. A lot of people like the GDXJ, which is the Junior Gold Miners Index. Of course, there's GDX also. Newmont Gold, which is Barrick Gold, and the Kinross Gold. Those have a tendency to do pretty well and perform pretty well, especially Newmont when it comes to. But remember, the Barrick and the Kinross and Newmont are companies, so they have earnings. So even though gold's moving up, if their earnings are bad, they'll probably be selling them off. So just beware of that. That's where ETFs are usually a better play, just because it's, you're actually trading gold or silver for that fact. SLV is the silver one. SIL, there's that one I was just telling you about. That's the Silver Miners ETF. So if you put basically H21 on the end of it, it's a futures contract. And without that, it's an ETF. Of course, you have Wheaton Precious Metals, Pan American, Mag Silver, and then, of course, First Majestic. I like looking at all those and playing with those around a little bit when it comes to the silver market. I prefer to trade the silver contract more than anything. But if I'm looking at ETFs, that's kind of what I'll be looking at. So what drives the price of gold? There's quite a few things that do that anymore. One is, of course, the US dollar. It's the global currency currently still. So as it moves around, you'll usually see gold move opposite of that. Now, sometimes they'll move together with each other, just depending on the economic conditions. Just recently, we had the dollar moving up and gold moving up. If you look at earlier this year, just because people were buying into both of them. Dollar started getting hit pretty bad starting in the summer when they came out with the first stimulus package, just because they were kind of liquidating our dollar. They were borrowing trillions of dollars, which we had to, quote unquote, create, I guess. And we still have the dollar, and it's still kind of moving down. Now they came out with another stimulus package, which is probably going to be hurting the dollar some more. So debt is a big thing that will move gold around. Of course, we have a huge global debt, not just U.S. Of course, we're the biggest one around. But with all the debt going around, there's going to be some uncertainty. So gold's been holding up and moving up. It's kind of corrected back off of its highs a little bit, just because, well, it went up real fast and it went up a lot. So it's kind of pulled back a little bit. Of course, gold production and wealth protection go into gold also, just because people like to hedge their portfolios and things like that with gold. And of course, it's an inflation hedge. As interest rates are moving higher, usually the dollar gets kind of beat up a little bit, and it'll push gold up and kind of go from there. Silver's a little different. Silver's more of an industrial metal. So you'll see it move around based off of manufacturing numbers, like the what is that thing? It's the University of Michigan Consumer Sentiment, but the other one is the Philly Fed Index. There it is. I can get it out of my head here. The Philly Fed gauges manufacturing and stuff like that in the Northeast. So if you have really strong manufacturing numbers, a lot of times you'll see silver push up based off of that. Weak, it'll pull down. So it might be moving opposite of gold when gold's spiking up. because things are kind of uncertain. You might have silver pulling down just because manufacturing is getting hurt. So you have to kind of keep your eye on that a little bit. And of course, there's investment demand and technology. How's no tech doing? They'll use gold and silver both in the technology realm, but they use more silver than they will gold. And of course, if the metals are moving, then you'll usually see silver moving along with them. So your strongest metal right now, I would actually argue would be copper. Copper's had a really, really nice run. It was down pretty good this morning, just because of Europe getting kind of shut down a little bit. But you'll usually see copper leading the gold and silver runs, and copper's been very strong lately. But besides that, you'll just kind of see them moving around, and sometimes you have no idea why they moved. There's always a reason. Sometimes you just can't find it. So when I start looking at gold and silver, I always like to step back and look at a real big picture. I want to see what they've been doing on a longer term basis and what's it doing now. And so I always throw up a weekly chart, and I chunk a 65-week simple moving average on it. And if you think about that, it's kind of a long-term moving average. There's only 52 weeks in a year. But I like looking at a 65-week average. Then I'll flip around and change that to a daily chart and see if the daily chart and the weekly chart agree with each other. On it, I like to use a 3-day, and a 21-period average. And that way it kind of gives me an indication if things are stronger or weaker. Now, I'll put the three averages, the 65, the 3, and the 21 on the same chart. So I'll put all three of them on a weekly chart and put all three of them on a daily chart. And not necessarily look at the intraday, like a 30-minute chart or anything like that. I'll just throw those on the daily or weekly chart just to see what their trends are doing. And I want to see if they're moving in the same direction. So here's a weekly chart. The red line is the 3-period average. The blue line is the 21-period average. And of course, the orange line, kind of orange anyway, is the 65-period average. So when looking at a weekly, you have a 3-week, 21-week, and a 65-week average. And you can kind of see they jumped up and hit that high up there at 2063, and they've been kind of pulling back a little bit. So you got the 3-period below the 21-period, which it's a little weaker, but we're still above the 65-week average. So on a bigger picture, we're up, as you can see. It's a nice little trend up. But here lately, we've been kind of pulling back just a little bit. So trying to buy it and at these lows and see if it will jump back up just depends on the day and sometimes the news is coming out. One thing I thought was kind of interesting was they spiked up, and of course the big rally kind of started back when they did the first stimulus, and that's where that big rise was, going up to all-time highs. But we started kind of pulling back, and I got to thinking, well, maybe they're just kind of waiting for the second stimulus. Well, now they got positive news on that, right, as of Friday or this weekend or whatever it was, and yet gold was down this morning. And I thought, kind of interesting. Thought they'd be trying to move it back up, but we'll see what it does. It's having a hard time right now with 1900, 1910 area, just trying to get above there and stay there. But it's holding up pretty well. Then, of course, we go to the daily chart. And this kind of gives you a different picture. It looks like it's fairly weak. And so when I see one that's kind of positive, one that's kind of negative, I sit there and kind of scratch my head a little bit and saying, okay, do I want to buy this thing or sell this thing or just give it some time to do something? And so I'll kind of sit back a little bit. I might dabble intraday on it, but as far as a longer term trend, I kind of keep my hands in my pocket and say, well, okay, that was a nice little trade up, or that's a nice little trade down today, but I don't know if I'd want to stay in that thing overnight. So until I have a definite trend, when I have the red and the blue above the orange on both charts, then we got a nice trade up, or they're all below that. But you'll notice, and I just took these pictures this morning, we're above the 65-day average, and of course above the blue and the red line, so that's kind of perking up. But if you look at back on the weekly charts, go back here, we're still below the 21-period average, which makes me think, well, they're hitting resistance on it. Can they really get through it? But that's the picture I look at. In fact, if you look at the computer behind me here, I keep all the commodities on that, and I have different tabs in my software that I have a tab for weekly charts and tab for daily charts. So I can just flip through those real fast just to see who's moving up and who's moving down and so on and so forth. So I don't have to keep grabbing a brand new chart every single time. I just flip around over there and just start going through the tabs and seeing what's moving up and what's moving down. And then I have a pretty good idea of what's happening in those markets. I've got a different feature in our software that we just kind of came out with not too long ago. And what it does is it actually tells you if, I guess, basically if something's moving up or moving down. But it looks at the year open, it looks at the month open, looks at the week open. It'll look at intraday opens and see if we're above all of those or if we're below all of those. So if we're below all of them, it's a star, I'll have 5 red stars. If it's above all of them, I'll have 5 green stars. And if it's kind of in between everything, you'll have different color stars, right? So I want to look at those as well, just to see how that's trading. Because you can look at a chart, but you'd have to scroll back and say, where's my year open? You might have to scroll back and look at where's my month open. But that just saves me a lot of time just looking at that real quickly and kind of going from there. And you can kind of see that back on that monitor. You'll just see some pages with some stars, just kind of real small, looking like in that little picture that I got there. But anyway, I can very quickly determine if something's moving higher or moving lower. And that's kind of the name of the game. You know, should I be long, short, or out of the market? And we have to answer that question each and every day or each and every click that we make. And there are times where being out of the market is a good thing. There are times where being in the market is a bad thing. So we're trying to get the most information we can to make a logical decision in the market. So now here's silver on a weekly, and you can see that it has a much stronger move. I mean, we went from down here, this $11, $12 area, all the way up to almost 30 bucks. Of course, it's pulled back a little bit, but notice it's actually acting stronger than gold is on this move back up. And that's why I say, you know, silver a lot of times will outperform gold. So I'll usually look to silver first just because it moves better. But it's more risky than gold is as far as the actual futures contracts are concerned. So you have to have a definite, I mean, if you think about the silver contract, for every 10 cents, it's 500 bucks. And silver can move around probably 30, 40, 50 cents in a day very easily. So you have to be dead on the silver contract, where gold is a little better. And that's why the micro contracts sometimes are really good, because I'll sit there and be thinking, hey, I think this thing's going to go up, but I want to put a whole lot of risk on it. So I might go over to the micro contract and chunk a couple on just to see what it does. And if it works, great. If it doesn't, well, I didn't risk that much, as opposed to a bigger contract. And it's the same thing that people will do between equity and equity options. A lot of times people will trade the option just because it's a whole lot cheaper than actually buying the stock, right? So, and that's the thing about the micros. And of course, there are options on gold and silver. Just beware, gold's pretty easy. It works just like an equity option. You look at the price, multiply it times 100, poof, there it is, because you're controlling 100 ounces of gold, right? Silver is a little different because you're controlling 5,000 ounces of gold, of silver. And so when you look at a silver option, if it's at 50 cents, that's half of the contract of silver. So if that's, instead of $5,000, it'd be 2,500. So 50-cent options, 2,500 bucks. A lot of people look at that and go, how can that be 20? It's only 50 cents. That's only usually 50 bucks, right? But not in commodities. They always go by the price per point of the underlier. So like on the S&P futures, it moves $50 per point. So if you see a $3 option, it's actually at 150 bucks, right? Just because it's $50 per point. So you always go by the price per point of the underlier. And of course, crude's the same way. You're controlling 1,000 barrels of crude. So you take that option price and multiply it times 1,000, and that's what you're going to have to pay for it. Or if you short it, and that's what credit you'll be getting, right? So, but anyway, back to this. So Silver's acting a little stronger, and of course, if you go to a daily chart here, it's actually perking up a little better than gold has, as well. And you can kind of see, I took this picture this morning, so overnight, we got a high up there at 27, let's just call it 75, all the way down to 25.16. So that's a $2.50 move inside of a day. That's on one contract, right around what, $12,000. So it's not a bad little move in one day. That's why sometimes I'll go over to the micros, just because it can move around quite a bit. When we look at gold, I look at the last two digits, even though it's at 1900, 1800, 1700, doesn't matter. I always look at where the last two digits are, and it's very, very habitual. I'll put it that way. The $20 to $30 range, in other words, if it's at 1820 to 1830 or 1920 to 1930, it has a difficult time with that going up through it or even coming down past it. Your next little spot's going to be between 45 and 50. 65 a lot of times gives that thing a hard time, and you can actually say 65 to 75. Sometimes when it gets below 70, it'll go hit 64 or 63 and then flip right back around. So you have just that range right there. And I like to see them get a couple of bucks past that range to say, okay, they've broken it. Then of course you get to the right around the century mark. But I always look at where gold is trading compared to these little ranges here, these numbers. And if I'm between them, then it's kind of a noise thing. So I'm thinking, okay, if we're trading at, let's just say 1885, I know I'm going to have a hard time buying this thing trying to get up to, 1900, just because there's going to be a lot of overhead resistance there. And that's just naturally what it does. But do I short it there? Well, maybe. See if it go down and test the 1875 area. But it'd be better if it would break one of these ranges to get there. But there are times, and we'll see this when I get to talking about it, that selling it in front of resistance or buying it in front of support works out really, really well too. Just like we've seen here lately, gold actually went down to 1863, something like that, and it snapped right back up. And so there are a lot of times that I'll see them starting to hit support and it's not breaking it. And so I'll buy it there because we can reduce our risk that way, right? And then see if it starts bouncing back up. So these numbers I keep stuck in my head. You can write them down, put them on a piece of paper, stick them on the screen, whatever you want to. But these numbers work very, very well, not only intraday, but for swing trading, because a lot of times if I get long at, let's just say 1831 or 1832, whatever it may be, and it gets up to 45 to 50 that day, it's hit resistance. And I'll sit there and go, okay, we'll see if tomorrow you can get through that or overnight or whatever it may be. And if it does, great. And if it doesn't, then I already know we've got some pretty good resistance there. So I might scrunch up my stop and say, well, either break it or get me out, and then start moving from there. But I watch these not only intraday, but on a swing type basis, knowing that I'm going to have resistance once we get from one point to the other, or support if we're short from one point to the other. So, and again, this is my daily chart here, and you'll kind of see it. I kind of got it off the screen, but anyway, this low right here is right around that 1863 area. This is where they kind of dumped off and they've bounced back up, but notice they can't get back above 1900. So they came down and hit that 65-ish zone, flipped back around, kind of plowed through the 75 area and kind of shot back up. And this is a daily chart, so it's kind of in this little, well, do I have a draw tool on here, don't I? Draw, yes. So, but that's what this did right there. So they snapped it back up, and then they started kind of moving things from there. Now, if you listen to Silas earlier, you can kind of see this is your 1, 2, 3 little thing, and then it kind of jumped above that and started taking off. See that? But I always confirm things with the actual numbers themselves. And if we go to, do I have that in here? Let me get my cursor back. There we go. Well, I didn't erase that though. Clear all drawings. There we go. So when we look at trading at short term, I'll use those numbers, and I don't look at, well, you can actually consider short term intraday also, but I'll usually enter on a day, which most people will do that, right? And then see how things go over the longer term. I use a 3-day rule, just to let you know. After the first day, if I'm being paid, I keep it. The second day, if I'm still being paid, I keep it. After the third day and I'm being paid, I own it, and I'm going to see how far this thing can go. If any of those days I'm down on the position, I'll usually bail them and say, okay, do over. So that I kind of use that 3-day rule to kind of give myself the confidence that my analysis is right. And I guess that's the best way of putting it. But I want to look at not only breakout moves, but also what I call value moves. I want to break below the ranges for the breakout, or I want them to be holding support or holding resistance at those ranges for the value side of things. So, and I don't think I updated these, but they'll tell you exactly what we're looking at. So here, gold, I'm gonna get my draw tool back. Draw. Here, gold came down into that 70 to 75 range. There it is. And it started bouncing. So I thought, okay, let's see if this thing holds in here. So I looked at that and I thought, well, if it gets up back above 75, 76, you can probably buy the thing. And that's exactly what it did. But look what it did. It came right up into that 90 to 00 range, and it just went, and it just couldn't do it. And notice it was holding above 90 and having a difficult time getting above the century mark. Well, when it took out 90, look what it did. It came right back down to that 70 to 75 range. And so the question is where is it trading based off the ranges? Because if I was looking at this and it was actually moving up, I'd probably buy it once it got back above 76, 77, something like that, just on a normal trend. But when I see it coming down here and bouncing, my thought is they're not breaking support, so they must be holding support, expecting it to move back higher. And if you think, instead of buying it up in here somewhere above 80 or something like that, and having to risk below the 70 area, why not try to buy it at 75, 76, and you'll have to risk about 5 or 6 points and see if this thing will move back higher again. So, but this is the actual breakout of that little 70 to 75 range, but it's also holding support down there. And of course, same thing when we were looking up here, they were holding this range here, just chewing it around and around. This is a 30-minute chart, by the way. And then it starts breaking back below that 90 area. So you could sell it up in here with the expectation of it not taking out that high. It was best if you got back below 90 though, again, breakout kind of, and see if it comes right back down to the 70 to 75 area. And I'm always trying to figure out what gold's going to do. Is it going to hold support? Because one thing that gold will, well, I don't want to say that. It has a tendency to go to each of those numbers or those ranges and hold before breaking lower. If it just starts drilling through them, then odds are there's news out somewhere that's making gold move. And they're just going to push it as far as they can, they being the traders out there. So, but I'm always watching to see where those levels are. If you want to, this is the breakout. I'd like to give it about 6 points above or below the range. That's a good breakout. If I'm real confident, sometimes I'll give it a couple, 3 and jump in anyway. But I like to give it a good 6 points to make sure it's broken, because sometimes, just like we've seen, and it went down to 63 or something like that on that 65 number, and it flipped right back around and bounced back up. But if it would have hit 59, I know it had broken the 65 and it's probably going to go down to that 50 to 45 area. But that's what I'm usually looking for on the breakout, is to give it just a little bit of wiggle room, and it can move 6 points pretty easily. But I always look to do that. So on the 70 to 75 range, buying it at 81. Unless it's holding down in there, then I'll try to jump in around 76 or so, a little bit early. But for the breakout, I usually will give it that 6 points or so off of those ranges. That gets you past the, I guess what do you want to call that? The tens, if you will, 70, 80, 90, 100, whatever it is. And it gets you back into the next set of, I guess, areas between that support and resistance area. So that's what I'm looking for each and every time I start watching to see what gold is doing. And again, here's your 81 buy. If you just waited to 81 and didn't want to cheat a little bit, but you could have bought this thing right at 81, which would have been right around in here somewhere. And it jumped right up to that 90 to century mark area. And so when you see this thing chewing around like this, what I'll usually do is I'll scrunch my stop up to like 89, just below that 90 number, and say, okay, bust 2000 or get me out of here. And of course, it took it a long time, and finally it said, you're out of here. But you could have reversed it right there also. So that's why I had my stop there, because I figured, well, if it hits there, odds are it will reverse. And it did do that. So, but watch out for that. When we're holding the range, I mean, break or fail here. And that's what I'm always looking for. If it gets in that resistance area or support area, I'm always asking what you're going to do next, because I want to see if it breaks out of that range or if it holds it and reverses off of that range. So if I'm not in a position and if it's holding, I might buy a contract. And if it starts moving back up, I might add to it once we get up to like 76, 77, and maybe add to it some more when we get to above 80. And then when we start hitting that 90 to century mark level, I might take some off, take the profit, move my stop up and say, well, break through here, please. And if they don't, fine, they get me out. But that's one thing that I'm always trying to ask is, do you have the strength to break, or are they going to reverse it? And those areas are going to be really big when it comes to resistance or reversals. And one thing you don't want to be is long at 91, knowing that you've got natural resistance there, even though it had a nice little 10-point move, don't get me wrong. And only for them to hold resistance there and just start dumping back off. And all of a sudden you're sitting there thinking, well, I'm long from 91. I have to have my stop below that low, which is down there at 69, which they almost got to it, right? So that's a lot of risk. So I'm trying to get in as quickly as possible to reduce that risk. And if you're wanting to probe at it, chunk a micro on there. I mean, if you're really thinking it's going to get up to 2000, getting above 90, throw a micro on it, and you're only risking $100 that way, and see if it goes up and breaks above that. And if it does, say it gets up to 2006, then you might flip over and buy a big contract and see if it gets back up to that 20 to 30 area, right? So that's what I'm always trying to figure out each and every day is this a good place to buy it, or is this a good place to short it? And it doesn't matter which side you're on. I think gold on a longer term basis is probably going to be moving higher, all right? Just because of the world debt and all this good stuff. So if that's the case, and of course, if our dollar continues to push down, it'll probably push gold up there as well. But on a shorter term basis, there's not any problem with trying to short the thing if it's moving down, or buy the thing if it's moving up. So it's just the best question is, are you on the right side of the market? So that's always what I'm looking at. And of course, you'll see now before this blue bar here, this is pre-market, all right? This is when gold was up there hitting that 90 to 2000 area. And then of course, once gold broke down, here's old GDXJ, it came right down with it. So that's what you have to kind of be aware of. If you're looking at any ETF, always look at the base underlier off of those before I start doing anything. even trading like, I don't know, Freeport McMoran, the FCX for copper. I always see what copper's doing before I look to buy or short that thing. So we always watch the actual metal itself, and it'll give you a pretty good idea. If you don't have a live feed, go to barchart.com or investing.com or whatever and grab a chart on there. One thing that's cool about investing.com, they'll actually give you a live quote on gold, even though it's a little bit, their prices are a little bit strange. It's almost like it's spot or the actual cash, but they're actually looking at the futures and they're giving a price on that. And same thing with the S&P and the Dow and the NASDAQ. They'll actually give you a live quote on that, but it's actually quoted on their page like it's the cash index. Gives you the dollars and the cents and all that good stuff. So, which is pretty cool. So if I'm out and about somewhere, I might throw up on my phone, just go to bar chart or go to investing.com and you can find out real quickly where things are. But you can look at these, and of course, here's silver kind of doing the same thing. When gold broke, it broke. So they were moving along with each other, and you can kind of see down in here, they were holding support down in here right around this 1830 area, and it kind of took off. And it kind of uses the same numbers as gold does, but you have a lot more room. I mean, you can kind of see here, they came up to the 2920 area, 20 to 30. There's that 20 to 30. They were holding right around this 2900 area. They broke below 90. They came down, actually made it down to that 50 zone. So big move in silver. I mean, 50 cents move is pretty big. In fact, that right there from what, 29.25 all the way down to 28.50, that's 75 cents. So that's what, 37,500, almost $4,000. So that's a pretty good move. So, but that's why the silver contract, I like to swing trade it. Trading it intraday will make you sweat a little bit just because it can move so much. And with this one, SLV is probably, or SIL is probably a better play on it. You don't have as much risk when it comes to the futures contracts, but gold, you can stomach a whole lot better. It's a much smoother trade when it comes to gold. So, and just real quickly here, options are one of the best friends to a trader that you can have. A lot of people like trading straight options. Buying, selling doesn't really matter. But one thing that I have found is they can turn a bad trade into a profitable trade, even though you're wrong. One thing I like doing with equities, I like to sell puts to try to buy them. Once I'm filled, I flip around, sell calls against it. Very, very simple strategy. But you pull in premium, and that actually allows you to kind of finance your stop a little bit. So if you have to risk $10 on a stock, and I can sell a put for $3, and then once I get filled, flip around and sell a call for another $3 or $4. That means I pull in $600 or $700, and so I can only have to risk $300 on my stop, right? If I have to risk 10 points. So even though I might lose on the actual stock itself, I might end up pulling in a lot of money when it comes to the options themselves. Options, I've been trading options for 25 years. So it's kind of second nature to me, but options can have a tendency to be kind of difficult for people. So I put together an option book just to kind of help, and actually put some trading strategies in it also, just to kind of help people understand options a little bit. If you understand insurance, then you probably understand options pretty well, because when it comes to insurance, if you're the insurer, if you're, I don't know, State Farm, right? When they sell you that policy, they'll pull it in premium. Now they're obligated to fulfill the terms of the contract, right? You being the purchaser of that, you have a right to exercise. So you pay them the premium, and if you run into your garage door to your car for whatever reason, and you want them to fix it, then they will come out and fix it because they're obligated to fulfill that terms of the contract. So that's, I mean, if you can understand insurance, you can pretty much understand how options work. Of course, there's only two types of options because there's only two things that you can do in a market. You can buy it or you can sell it there. So you have one option that allows you to buy and one option that allows you to sell. And of course, they can get pretty complicated from there. There's probably as many option strategies out there as there are grains of sand. But one website that's really cool is options, plural, playbook.com. And it's a free site, but it goes through a whole bunch of different strategies and stuff like that. And it's kind of a neat little thing to use. But I put this together just for people to be able to understand options a whole lot better. And I do give some strategies on trading options, just because it gives you a better idea on how you can use them, which option to buy, which option to short, trying to find the right option. And that's the biggest thing. A lot of people think, all you can do is lose money in options just because of time decay. Well, the thing about it is if a stock is trading at 100 and you think it can go to 110 and you buy a 110 call and the stock goes to 110, you can still lose all the money out of that option because it never had any intrinsic value. So what you want to do, even though it costs a whole lot more, is you want to buy the 100 call and see if it gets to 110. So instead of having to pay $1.50 for the 110 call, you might have to pay $3 or $4 or even more for the 100 call. But at least you get intrinsic value and you'll be paid on it as opposed to losing everything just because, well, your analysis is right, but I bought the wrong option. And that's one thing that this will kind of help you do, is try to figure out which option to buy or sell. So, but this right here gives a guide to weekly options also. A lot of stocks have weekly options. Even in the S&P, you actually have 3 expirations in a week. You have Monday, Wednesday, Friday. And they also have end of month. So sometimes you can have 4 expirations in 1 week with the S&P options. Pretty cool. But I also talk about doing bond options for the 30-year Treasury bond. It's a really neat way of kind of pulling in income on a weekly basis. And what's really interesting is, I don't know why this is, but a lot of trading platforms don't have the weekly bond options, and a lot of them do. So if yours does not have the weekly bond options, then what I would do is wait till the last week of the month and then do the strategy. So you'll be able to do it once a month, but it's great for the weekly options. It allows you to pull in anywhere from 150 to 350 bucks on selling the calls or selling the puts, depending on the trend of bonds. And it kind of helps pay the utilities. I'll just put it that way. So also put in here the biggest mistakes traders make and how to kind of deal with them. I've been through the school of hard knocks myself, gotten beat up a little bit, and been rolled around in the dirt and got back up and dusted myself off. And just like Silas was saying earlier, you have to kind of calm yourself down and go back to the basics a little bit and say, okay, what am I really trying to do here? I mean, trading is fun and trading is addictive, but you're really trying to make money. And one thing about the market, who's your employer if you're a trader, you have to do what the market tells you to do. And if you don't, of course, you're going to get fired. And so it'll drain an account pretty easily. So nobody's going to be 100% correct. No one ever has been, and you're going to have losses along the way. But as long as your gains are much better than the losses, you're a whole lot better off, of course, right? So, but I'll also go through what we call our horse race trade. And this is an intraday trade. So there's some swing stuff in here, but there's also this one. It's made basically for, I always say the NASDAQ stocks just because they move a whole lot better, but there's ones on the New York that move around a lot. And what this is doing is we're trying to find out in the first 10, 15 minutes of the market, who's the strongest and who wants to go up, or who's the weakest and who wants to go down. and we jump, of course, again on a weekly option, and it goes through all that to let you know what to buy or what to sell, right? So, and of course, there's also income strategies that are more on the swing side of things. And today, if you would like to jump on this, it's only $7. If you'll go to dtitrader.com/ultimate, or of course you can call here at 904-416-1776, and we'll be more than happy to help you out that way as well. But it's not much, and it's a great weekend read. Won't take very long, but hopefully it'll help you understand options a little better. So I think with that, David, if there's any questions, what is the options? Let me type it in here for you real quickly. Make sure I spelled it right. There we go. That's the site, Martin. But it's a cool little site. You can actually look at each of the different strategies. If you want to know what an iron butterfly is, or know what a straddle or a strangle, or verticals and all this stuff, it has all that on there. You can just click on it and it'll describe it to you and why you would want to do it and all that stuff. So, but anyway. And if you do have questions, I spelled that right too. That's my email address. Once in a while, doing these things, people try to get a hold of me and they want to see about this or that or the other. But feel free to pop me an email. I'll be happy to get back to you.